Hey everybody, welcome to this webinar. Hopefully everybody can hear me okay. I'm Shane Smoleny from Wolftrader Futures and we'll be started shortly. I'm just going to be doing some sound checks and mic checks to just let me know that you guys can hear everything okay, and then we will be started. So we always try to do different topics, so today we're going to be doing a different topic. We're going to talk about options and type 1 and type 2 errors. This is a different topic than we've talked about. In the past, we've talked mainly about features on new services and the Fed juice and things of that nature, but today we're going to dive into a little bit of the thought process that goes behind these option trades. And just to let you know, I'm relatively neutral on this topic. I recognize the fact that these tools can be very useful in many ways, and they can also be very harmful in many ways. So I'm going to try to lay this out in a balanced fashion. I am going to take a bias against the randomness approach, which we will get into, but that's a very common theme that people take to options, that this is just a random thing and the markets are not patterned. All right, so if everybody can hear me, we will get started. All right, so first of all, if any of you need to reach me, this is my contact information, Shane@wolftraderfutures.com or www.wolftraderfutures.com. You can also reach us at fedjuice.com. This is the YouTube channel that you're at right now, Wolftrader Futures. And then this is a Twitter at Wolftrader FUTU1. We also have another Twitter at Wolftrader1, which is where all of these charts are documented, which I'm going to show you today. Everything that I show you is documented and time-stamped on Twitter. So these are charts that actually happened in the past. So none of this is writing stuff in after the fact or back tests or anything like that. This is all documented stuff. So today, the agenda, we're going to talk about news and events very briefly, and then I'll talk about the hot symbols again for frequently asked questions. And then we're going to get into the main topic of this webinar, which is type 1 and type 2 errors. And you may have heard of this in statistics, but it applies to options because it basically breaks people into two different camps of thought process on options. And then we're going to talk about the gold standards, brief market update on the S&P. I don't have too much today on other markets. And then we will get into some questions. As always, if you guys have any questions in the chat, you can type it in and I will answer those questions. This is a look at our different services. We have multiple newsletters here: S&P newsletter, metals, energy, currency, cryptocurrency, the Uranian newsletter, which is astrology based, not necessarily to do with the markets, but very interesting nonetheless. And then we have our stock, ETF, and Fed juice service, which is on fire. The calls have been incredible. I'm going to show you some of those charts. If you take all of these together, this comprises the gold membership, so you can package that together if you want a discount on that. Then if you want to go for the platinum, this is where we have the live Twitter feeds all day. We have our trade services here, the Fast Fed, Easy Timer, Fed Juice 3.0 ETFs, pairs traders, which we're adding. We just added the pound yen with corn and wheat, the K2 trader, and then all future services are grandfathered. So if you get in early, and I still think it's relatively early, you can lock in those rates. These services do go up through time. They will go up. These are rising, appreciating assets here. They do go up. So in October, this will go up. The stock ETF and Fed juice service is starting out now. Anytime I start out a service, you guys know I started at a low price. This is $59 a month. It will go up. So if that's something that you're interested in, it's a good time to check it out because we're probably coming up to about the last 6 weeks here where I'm going to have this at a discounted price. So taking a look here, this is the different packages that we have. We have the S&P here, which I will highlight this for you here. This covers the S&P 500. It also covers daily updates. Then the metals, we have copper, gold, silver, and platinum. We have energy with natural gas, oil, heating oil, and gasoline. We have the US dollar, Canadian dollar, British pound, euro, Japanese yen, Australian dollar, and euro dollar. In crypto, we have Bitcoin, Ethereum, Ripple, and Litecoin. These are going to be coming with live Fed juice, by the way, very shortly. We have corn in the 10-year bond, and then we have Apple, Tesla, gold miners, Caterpillar. We also have Broadcom and Bank of America, and that's going to be adding out to probably about 10 symbols. So that Fed juice ETF service, we're going to talk a lot about that today, actually, with the options. I'm going to show you some incredible looking charts. And again, all of this is all time stamped on Twitter. So you can go back through the history and look at it. Nothing funny going on here. Disclaimer, real quick about trading in general. Trading commodity futures involves a substantial amount of risk. Past performances do not indicate future results, and this happens a lot. You can have trading systems that are working, and then all of a sudden they stop working. But I'm always on the go here to try to get things resolved if things slow down. But this is designed to be an educational service to go with the book, A Trader's Guide to Financial Astrology. This service, this newsletter, is separate than my firm, Trading Ridge Analytics, and the strategies are different. So there's nothing going on between the two directly, and then everybody gets the same data at the same time. So this is a newsletter. It's just a broadcast event to everybody. This is not personalized service where I talk to one person over another. Everybody just gets the same thing at the same time. All right, so next thing here. Warning about using fragments. So I would warn people, I'm glad if you're coming here on a weekly basis to check this out, but I would just warn you about using fragments because things can change very quickly, as we saw with the S&P this week. In fact, day to day, things can change tone. And so if you hear something today, it could be different Monday at the close. So you're getting information gaps. So I just want to warn you about that. I don't just make one call for the month and that's it. I look at what's going on with the Fed and I get feedback. So everything we're doing here is the current distribution of the market is dependent upon prior distributions. And so that can change. As we get new information, it changes. Terms of service, just so you know, we never share private personal data. So that's just something I don't believe in. Usually when you look at a terms of service and you check the box and you just go on, they're basically saying we're going to sell your data and there's nothing you can do about it. And I never do that. I don't buy lists of people. I don't sell lists of people. I don't share your information. If you're signed up on my list, you physically sign up. Okay? And you can unsubscribe at any time. If you get an email, it's because you signed up. That's all that means. So my basic terms of service is that you understand the risk involved. That's my main thing, to understand that you understand this stuff is risky. Things can work. They can stop working. It's not always perfect. Okay? But I think we do pretty good. So I just want to make all this clear up front. I'm never going to be advertising wild claims. You'll never see any of that on my site. My main focus is that you understand the risk involved here. Okay. All right, coming up here, if you get a chance, we'd love to see you on the 25th, which is Wednesday, and we're going to be talking from 1 to 1:30. You can sign up for the Money Show. It's a free webinar. We're going to talk about how to balance the Fed juice with seasonal market patterns. And this is essentially talking about the concept of divergences. So divergences can help you understand a projection into the future. So if you have a negative divergence, something is wrong. Positive divergence, it's actually the market's getting strong ahead of the seasonals. And like right now with gold, it's diverging negatively with the seasonals. So if that's something you're interested in, come on over and check it out Wednesday at 1 o'clock. Okay, news and events. So the Money Show, obviously, I just mentioned that August 25th, 1 to 1:30. And like I said, it's free to register. Stock ETF service, that's up and running. Doing well. We're going to add another symbol soon. We have 6. We'll probably get to 7 here in the next week or two. Fed Juice 3.0 is now running at a 4.44 resolution. It's looking better. So everything is running, and we're going to have concentrated signals with the Skynet soon. But right now in the S&P, I'm just looking at the big picture still, which is negative. Easy timer, this is a big one. I've expanded this to 24 hours. So instead of just trying to focus on the morning session, which is chaos, I'm looking at a 24-hour window. So a lot of these trades are going to go off at night now. So if you are a member and you are doing the easy timer, like we'll have trades at like 3 in the morning, 2 in the morning, things like that. So you can set this up on a timer. If you use TD Ameritrade, they have a way to set trades up so you can just let it execute at a certain hour with the brackets. So I found that the 24 hours is a better way to go because we have more information. There's, rather than just trying to focus on that market open. And we've seen the market open has just been completely chaotic in the last couple of months. So I'm trying to focus on zones that might be a little more quiet that we can get patterns established. So I'm remodeling this fast fed to be break even. So, that is looking much better. Now, streaming crypto, I keep talking about this. It is coming. I need to upgrade a couple of my software modules to be compatible with this, but this is coming. So what this means is that we will have more Fed juice history for the crypto and probably Fed juice for the big ones, Ethereum, Ripple, Litecoin. August newsletters are available. Obviously, we're coming up to September, but check it out. It's a 7-day trial. So, frequently asked questions. So I'm going to cover these real quick. What are the hot symbols on the double lunar cycle? Double lunar cycle is an astrological based cycle that's different than any one that you've seen. You may have seen these before with other services like a lunar cycle, but this is different. This one is very fine tuned and we take it actually it's 3 layers now. It's actually triple, but I left the name double just to avoid the confusion. But there's multiple layers that go into this, and these are the symbols that are doing well: gold, silver, corn, Canadian dollar, British pound, euro, and Bitcoin. They are doing very well. So these are signals that are just given at the beginning of the month. And these markets, gold has been turning to the day on these things. It's been pretty incredible. What are the hottest symbols for the Fed use? Silver, corn, natural gas, the euro dollar, GDX, and Tesla. Although there's others that are doing well too. And then solar cycles. The hottest symbols for the solar cycle right now are copper, oil, natural gas, euro, British pound, euro dollar, and Bitcoin. Although Bitcoin is deflecting a little bit off that solar cycle now, it's doing a little bit of a rally, but it has been modeling the solar cycle very well. So this week it's hooking away from it. The solar cycle's pushing down on Bitcoin, but okay, that's what's been going on. All right, so let's talk about the type 1 and the type 2 errors. So type 1 and type 2 errors in options. This is important because it ties in a little bit to statistics, not too much. We're not going to talk about tails and distributions and p-values and things like that, but the basic concept is there. And the reason why we should talk about this is that options amplify type 1 and type 2 errors. In other words, these two types of errors are really amplified through the use of options and the time decay and the theta and the volatility and all this stuff. Also, if you are dealing with trades that do not use stops, or you're dealing with trades that are pyramiding, these are all classical type 2 errors that will show up. All right. So what is a type 1 error? Well, type 1 error is typically a false positive. So in statistics, you're rejecting the null hypothesis when it's true. This is the false fire alarm that goes off. Okay, so this is an error, like, hey, the alarm went off. Okay, great. It caught everybody off guard, but at least the alarm is working. It's just extra sensitive. The only problem is when you're dealing with option markets, when the false alarm goes off, you lose money. Okay. So the focus here is on losses. When you're talking about a type 1 error, you're just constantly looking at the losses because they're happening a lot. This is trading with controlled risk. It's the equivalent to buying insurance. So if you buy insurance, you usually don't use it. It's just like you're throwing money away all the time, but you might need it. And when you need it, it's a big payoff. Okay, so that's what a type 1 error is dealing with. You're just constant small losses, constant false alarms. this is important, type 1 error. There's a strong feedback loop here. This is a good thing. You get to see what's happening quite a bit. You're not in the dark. If the alarm is extra sensitive, it's going to go off all the time, and you're going to know if there's a problem. You feel more confident that if something really big happens, that the alarm's going to pick it up. It's better to have an oversensitive fire alarm than one that's not sensitive, right? So what are the trade scenarios here? Well, type 1 errors typically occur long options when you're long premium, okay? So you're long premium, or you trade with really tight stops. You're getting stopped out all the time, 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 right? So this is the scenario that we're going to focus on right now. And again, I'm relatively neutral on this. I mean, I see the pluses and minuses of being long premium and short premium. They both come with their inherent advantages and disadvantages. So my biggest thing about this that I'm going to take issue with is the randomness concept, but I'm going to explain to you where that comes in. Okay, so there's certain people that follow these personalities. There's type 1 error personalities and type 2 error personalities. So a type 1 error personality is typically going to assume that the market is orderly, that there's some order to the market, and they expect this big move. They don't think it's random. They expect this big move. The positive traits of these people are they typically tend to be optimists in life. They're optimistic. And they can be inventors. These are the people that actually come up with things, come up with ideas. They take chances. They're trying things out all the time. Edison trying out hundreds and hundreds and hundreds of light bulbs, and eventually he gets the light bulb. These are people that do things actually to bring stuff out of nothing to create it into society. The negative traits is that these are people that can also cry wolf all the time. They can be like warning and warning and warning and warning, and then finally when it comes, nobody wants to listen. And they might think that the market's out to get you. These can be people, these can be like conspiracy people, conspiracy theorists. They believe every single story that they hear, right? So, that could be a negative trait. But that's what comes with this personality type. Now, when we talk about trading, how would you visualize what this looks like? So this is what this looks like. Type 1 error. It's a zero-sum game. If you believe it's random, it's zero-sum. Okay. So you get a series of frequent losses, loss, followed by the occasional big winner. So this is like the insurance concept. You're paying out insurance all the time, and then you get the big payout. Okay. Now, many of the top hedge fund managers, if you listen to market wizards, this is how they do it. They have very low win rates, maybe 10% win rates, but when they win, it's huge, right? So this is why I say this type of strategy is completely valid. There's many people who have done this, but right now it's not necessarily the popular one taught. But this is what it looks like. So loss, 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 false alarm, false alarm, false alarm, false alarm, false alarm, boom. Okay. So there you go. But this comes with all kinds of pitfalls, which we'll get into with volatility and all this different stuff that really makes it difficult to time it. So just because it's possible, and psychologically, you got to deal with this. Psychologically, you have to really believe in your plan as you're taking loss, 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 or small loss to get that big one. And then you got to be disciplined enough to let it go. And most people aren't disciplined enough to do that. You have to be way more disciplined to be this type of a trader. Type 2 traders, it's like low discipline. Okay. All right, so when you're long premium, when you're long an option, there's some advantages here, okay? So the advantages are you have a strong feedback loop. You know what's going on all the time, so if something's going bad, you'll know right away, okay? And you know a lot of the time. So it's like right away, it's kind of like a mark-to-market thing. You know what's going on. You have very controlled risk. When you purchase something, your risk is defined. When you purchase an option, it's defined. Okay, there's ways to define it with spreads. We'll get into that later. I'm just talking about being long on premium. You got a controlled risk. That's a really positive thing. So brokers like this because they don't want to take on your risk. If you're short premium and you don't have a controlled risk, they don't like that. Okay, large gains are possible. This is a big one. Now, this is a point of contention because a lot of, there's an adage in trading which is, winners focus on how much they can't lose and losers focus on how much they're going to gain. And I think there's some truth to that. But if you have a disciplined system and you're over and over and over and over and you're disciplined with your approach, this is the way to do it with the long premium. Okay, it's just you have to deal with this. Now, this is a big one. I think this is a big advantage here because if you're long options and you do it a lot, you have the ability to take losses. That's huge, man. That's huge. So you have to understand that losses are part of the game. And if you are long options a lot, you take losses a lot. That's good. That's actually a good thing that you can do that because we're dealing with reality. Okay, you're dealing with reality, and that's good. Small losses, right? But losses. And again, this is not a course on how to trade options. I'm just giving you a high level view. I can do, other videos about how to construct spreads and all these different things using options if you want. We can do that in another video. If you guys want to see that, let me know in the chat. This is high level today. All right, so here are some disadvantages. Now, you do take a series of small continuous losses, and those are losses. So if it shakes you off of your game plan, that can be bad because you can start zigzagging around to different strategies, and then it can just be forever losses. You can only make money in one direction. That's a big one. For the most part, this is true, unless you're dealing with, you get into a debit spread or something like that. But I'm just saying if you're just long options, typically it's a one-directional move. And the move needs to happen fast. Like you need to you buy the option and it needs to go. Okay. But that doesn't always help you. Like if you're long premium, it can go in your direction. You can lose money because decreases in volatility will hurt you. So I've seen this many times across earnings, and we'll talk a little bit about this, but let's just say that you have a stock that's going up and it's up like this and there's earnings and you're betting that the thing's going to go down, right? But the implied volatility is really high, right? This thing can gap down the next day and you bet that it was short and you can lose money, okay? Because the volatility can just suddenly collapse. So this doesn't come without pitfalls. This is really risky stuff. And you need to understand implied volatility and also Bollinger Bandwidth, which we'll get into. And then time decay hurts you. So it's a depreciating asset. And there's also wide spreads too. The bid to ask is wide compared to like a liquid ETF. So there's all kinds of issues here too. This is not without issues. And so, like I said, I'm trying to give a balanced approach today for one or the other, for both of them. Okay. So here are some issues so I gave the disadvantages, but here's some, like, I would say personal issues that people can encounter with being long premium. Number one, if you concentrate your positions, that's not good. So if you can afford 1,000 shares, you shouldn't be maxing out your buying power on that stock. You should be allocating the proportional amount of shares and options. If you become too concentrated, that's a big problem. Okay, so people assume that if I can spend $10,000 on the stock, I should buy $10,000 on the option. That's not the case. You should be putting way less into the options because of the leverage. Okay, the next one is intrinsic and volatility decay. So we talked about this before with the volatility, and also intrinsic. Every day it's decreasing. The theta increases across time. It's a decay function. So this thing better go, and it better go quick. And this is why you get a lot of small losses with long options. And it's crazy to try to do stops on these things because you should just look at it as an insurance. This is a big one, lack of discipline to let the winners run. So this is huge. Like most people want to take profits quick. So if you've been seeing loss, and then you're like, oh my God, it's winning. Let me take this to make up for those losses. You're not gonna make it because you need to let that big winner run. And that's hard to do. That psychologically, that's hard to do. So the lack of discipline. So that's what I'm saying. And then the morale. It's a morale drop if you're trading and you just see loss, and you see a bunch of them. And you may not even get to that big winner. You may just be like, ah, these options, these long options they're terrible. You may not get there. All right, so, and again, loss of confidence in the plan after a series of losses. So you might zigzag around to different plans. And usually when you switch to a plan, this is like the worst thing that traders do. You know, I have system A and system B, and system A it was making money and starting to lose money, and then and system B was doing the opposite. Now system B started to make money, so the trader switches to system B right at the point where system A was about to start making money, right? And then system B starts losing money. So what happens is you jump to losing system to losing system to losing system, because you're like, hey, this isn't working, this isn't working, this isn't working, this isn't working. I'm going to jump to this one, which is better, and then that one's at the peak and that one falls. And so it creates this cycle of just constant losses, right? So when I say lack of confidence in a plan, so these are big issues to overcome. There's no doubt about it. This is not for the faint of heart, but I'm just pointing this out. So that was type 1. Now type 2 error. This is the big one. This is way bigger than type 1, because type 1, it's like paper cuts. It's like constant, slow. This one is the big deal. This is the false negative, and this is saying everything is fine. Everything is fine. In fact, not only is it fine, everything's fantastic, right? This is the fire alarm that fails to go off during the fire. Okay, so you're sitting there and you think everything's fine, right? And the house is burning down, right? And so that's a way more devastating than a type 1 error. So this is the one that really can torch you. And I'm going to show you some examples of funds that have collapsed and how this profile works, because it's very deceptive. It makes you think that you're doing better than you are, and then it comes. Now, these people tend to focus on the winners because they're getting a bunch of little winners, right? This can also happen when you trade. So when you trade this is unlimited risk. So the price that you pay for those series of little winners is unlimited risk. And I'm going to call this the shark. The shark will come and get you 100%. It is coming if you play these games with the type 2 error. I promise you it will come to you. It's just, it's basic probability. It will come for you, okay? And in today's environment, with these huge outlier events and huge tails of risk, the shark comes more than it used to in the past. That's for sure. This is the equivalent of selling insurance. So, you know, you sell insurance, and insurance companies they do great, right? They figure it out. How much do I have to sell? They're just collecting premium all the time until they have to pay out. And then if if a coastline gets devastated by hurricanes, right, then the insurance companies can go out of business because they can't pay for it, right? This is a weak feedback loop. You don't know what's going on with a type 2 error. You have no idea what's going on. You think everything's fine, and then kaboom, it goes. Okay? So keep that in mind. All right, guys. So any questions so far on this? I'm just laying the ground in terms of the mentality or the thought process here. And I'm going to go on about the type 2 errors, because this is catastrophic, guys, if you get sucked into this. And this is like, there's like a cult following with this type of thinking that goes on. Type 2 errors. So this one dovetails into a lot of different problems here. Number one is short options. If you're just naked short options, you're short premium, you're gonna get smacked in the face. And especially in this environment here. Now, your broker may require you they're going to require you to hold a certain amount of money, but it can overshoot that, and then the broker can be liable for you. Brokers don't like this, because black swans happen, and the volatility is absolutely crazy right now in many markets. Now, the other way that this can happen is if you trade with wide stops or no stops. I cannot tell you how many people have come and told me, I've got this great trading system. I was up 3,000%. I took the account from 10,000 to 300,000, and then it blew up. Okay, why did it blow up? Because you don't use stops. That's why it blew up. Or you use wide stops, right? Okay, that's why it blew up. Okay, and so this is a type 2 error. It's a false sense of reality. So, you know, your equity graph you get these strings of winners, right? And you see the equity graph and it looks like this and you think, wow, that's incredible. But what they don't show you is in between, there's these huge drawdowns to get to this point, right? And then eventually what happens is there's a drawdown that doesn't come back, okay? That's a type 2 error. It's a false sense of security. All right, so that's very common for people to say, oh, I have this great system, I've done this, I've tripled and quadrupled, and it just, no, it really wasn't that good. Okay, it's relatively, to believe it or not, it's relatively easy to get winning streaks going if you trade like this. Okay, so today it's just talking about the scenarios. The next one is pyramiding. So, if something's going against you, you start buying more and more and more, and then your break even is smaller, so then you get back here, so then your equity curve doesn't show that. Your equity curve just shows that you're steadily going like this, and it's the same concept. It's a false sense of reality. Okay, these are big problems. You just understand this. Understand that this is what you're up against with this type of thinking. And why is this? Because people don't want to take losses. People don't want to take losses. This is why. And they want to feel successful. You want to feel like, hey, I'm making progress. My option trades are consistently winning. I'm on a winning streak. All of these things, right? But that's not reality, right? That's not reality. Okay. This is big. Type 2 error personality. These people, a lot of these people that trade the options, they believe that the markets are random. This is a big thing. And they point to the fact that there's all of these models and all of these systems, and statistically we can model the markets as random. And they point it out, and here's what it is, and here's the percent chance that it goes on these dates, and there's a parabolic cone that goes out, and as you get out to across time, it follows this distribution, and the price can be further depending on where you are across time. These are big random people. Now, the positive traits of these people is, I'm going to put this as a positive, they're pessimistic people. They're skeptics. They're skeptics. They're like, there's no meaning to any of this. Markets are random. It's all nonsense. I've been in the business for 50 years. I've never seen a system that works. You just got to play the odds. And so these are formula users. So these are people, they don't really discover anything. These are like, you're talking about scientists. These people, these are not the people that discover things in the world. These are people that look at formulas and they say, look at the formula. Works every time. I'm a rational person. Look. Formula for gravity, GMM over R squared. That's Newton's law of gravitational attraction. It works every time. It's perfect, right? And they stay in this world of the skepticism. I rely on formulas, but that's just how they are. The negative traits of these type of people are they miss the big train that comes. So because they're skeptical all the time, when the next train comes down the line, the big one, they miss it. They miss the opportunity because they're skeptical. And the other thing is that I'll put in here is I would call like a false wisdom. So there's like a persona that goes around being skeptical. I'm the skeptic. I can't be debated. It's all nonsense. It's all fake. And so there's this fake false wisdom that makes you appear more wise than you are, but you're not really. You're just taking one side. There's no thinking going on here. You're everything is fake, right? You're the skeptic. Everything is fake. It's all nonsense. I don't believe in any of that. But what you're really doing is you're just taking the opposite side. You're not really doing any thinking. Okay, so just want to put this out here now. What does this look like? Well, here's what it looks like. I got my picture of the shark here. So the type 2 error trade sequence. So you're going to get a series of small losses, and you're going to think that you're some type of a genius. And then the shark's going to come, and you're going to be devastated. Okay? And I promise you the shark will come. It's just a matter of time before the shark comes. And so all of these problems roll into this that I talked about. You think you're rational, you're a pessimist, the markets are random, you're going to go with the models. Well, guess what? The models break down. And I'm going to show you in a minute that because you can model something as random, it doesn't mean that it's random. Okay? That's the big problem. Because you can look at your model, you can say that it's random, but I'm going to show you some charts that are not random in a second. But I promise you the shark will come. Okay? So understand this. This is the risk. If you're going to do this premium short stuff, this is the risk. Now, there's ways to get around this. You can do spreads and you can cover a leg of this and make it so there's a finite risk. But I'm just telling you, this is the thought process that destroys people. This is why people blow up accounts, because they don't have the discipline to take losses. Okay? Just pointing it out to you. It's a mindset. It's like this is like a cult mind. These are the most cultish people. I'm going to talk about. There's like a cult of personality with this type of thinking, with the premium sellers. And again, they both work. I mean, I'm not saying that they can't work. It can work. And like I said, I'm balanced on this. I'm like neutral, and I think debit spreads work. I think credit spreads work. I think long options work. I think short options work. But understand the pitfalls that come into this. Understand the narrative that sucks you in. And you think that you're doing better than you are because of human nature. You want to see progress, and then here it comes. Okay? Be careful about the shark. And because you're not getting feedback, remember I talk about the feedback loop, you don't know what's going on. You could think everything's fine for months and months and months, and then kaboom, gone, right? So be careful about this. So what are the advantages of being short premium? Well, you have a small series of small continuous gains. So if you're feeling good about yourself, right? Hey, look, I'm getting gains, and I can. And this is a big one too. People love to talk about this one, but I don't really think it matters too much. But if you follow a disciplined approach, you can do just as successful with the long options. But this is what people point to. You can make money in down, sideways, or up markets. In other words, you can have a position, and the market can go to some degree, wander around. And sideways, you can make money. You could have a long position and it could go slightly down, you can make money. Or if a long position goes up, you make money. So the move can occur slowly. So unlike long options where it just has to go right away, this one can occur slowly. So it can kind of drift around through time. If you want it to go up and you think it's going to go up slowly, then you can be a seller. Decreases in volatility help you. That's interesting. So if you see the volatility high, but the problem with this one is it's much easier to spot a low in volatility than a high in volatility. I'll talk about this in another chart. So you can think volatility is high, but it can keep going higher, like we saw with COVID. So you can think, hey, look, the volatility is high in COVID in April, and it just keeps going higher all the way through May. So time decay helps you. So this is what everyone loves to talk about with the theta, and we have this curve. It's a nonlinear curve. It's a decay function. And they love to sit there and get in on the sweet spot and get out here. And okay, that's a positive. That's definitely a positive. Makes you feel good about yourself, like you're accomplishing something, right? Short premium disadvantages. So there's low feedback loop from the shark. I just talked about that shark. There's no way to know when the shark's coming. You think you're doing fine, and then kaboom, it's gone. Okay? The losses can be catastrophic. And I'm going to put this in here. There's like a cult following with this type of thinking. Like people are like convinced that this is the only way to trade options and that if you go long options, you can't do it, which is not true. But they're just like convinced of this. These people are like, oh my God, like don't go against these type 2 error people. They're convinced. It's all random. The only way to do it is to sell premium. And anyone else you're an idiot if you don't believe this. And look, I can model it on my computer. Look, it's modeled. Look at all this Black-Scholes model. Look at all this different stuff. I'm just telling you, that's the mindset for whatever it is, good or bad. All right, so let's talk about the short premium issues, and then I'm going to get into some charts. I'm going to show you some of my charts. So here's the short premium issues. Number one, just like with the long positions, if your position is concentrated, that's a big issue. Just because you have the buying power to do something doesn't mean you should do it. Okay. This is the next one. Lack of discipline to take winners off. You can be very lazy with shorting the premium. I see these people. These are like lazy people, like in terms of compared to dealing with long options where you have to have a disciplined strategy. This is kind of like, but sometimes they don't take the winners off. There's a decay function where you're probably not going to get all of the premium, and you're going to get a good part of it here. So you really need to be taking the winners off. So it's kind of the opposite of the long options, but some people don't do that, right? So they hang in with the position too long, and then it can spike against them. So, You know, this is the opposite of the long options where it's good to take this one off. If you're in the decay function and it's coming down, it's good to keep taking these off. So these are shorter term trades. Lack of awareness of the shark, like I said, pretending like it's not there. It is there. It's coming. You swim in that Gulf Stream long enough and, 3,000 feet of water, shark's coming. This is another one too, underestimating the opponent. When you have a position, and let's say that you're in a stock or a futures, and you're just going to sell a put way down there, right? Like, it can't go there. Yes, it can go there, and it will. When you're dealing with volatile markets, just because you put something far away doesn't mean you're safe. So if you're just selling puts and selling puts and selling puts, look, if you're going to sell puts, you better be comfortable owning the stock at that price. You better view it as a value because it can go there. I promise you that, especially in this environment that we're seeing now, like with COVID and the volatility. We're seeing it with gold markets. We're seeing it in grain markets. It can go there. So if you think that's like you're underestimating it, that, oh, it's so far away that nothing's going to happen. No, it can go there and you can get smacked. There's a lot of issues with being short, guys. This is another one, the false claim to have an advantage over long premium. I don't think there's an advantage here. I just think it's the way you approach the ball game. Depending on it depends on your personality too. Like, we'll get into this. Like, if you don't like to let your winners run, then probably short premium is a better deal. If you want to take your trades off all the time, it's probably a better deal. But if you're one of these people that believe in a company or a trend or a home run hit, the long options can be the way to go. But here's another one down here too. Failure to cover into expiration. Like, guys, if you don't cover these, if you're short premium and you don't cover into expiration, all kinds of weird stuff can happen. You can get assigned, or last minute moves can happen. So, a lot of times that people just want to let things expire, it's probably not a good idea. But that's just kind of a random thing. Usually you're okay if you're out of the money, but this is the one here that I'm gonna hammer on this a little bit, guys. I'm gonna hammer on this. So let me just get into this. Avoiding directional plays because the market is random. So a lot of times people do these butterflies or these iron condors. It's random and there's no direction. You can't predict the direction. So I'm just gonna do non-directional plays all the time. Okay, that's your thing. But the market's not random, and I'm gonna show you this in a minute. I think that's a negative. That's a negative because if you find a good model, the market's always directional, and you can combine these concepts together to get a better direction. Now, sometimes it goes sideways. I mean, sometimes, like, if the volatility has been huge, the volatility can expand. The markets can go sideways, but technically, there's always a trend. Is what I'm trying to say. Let me talk to you about a popular Type 2 error book. This is just an example of the Type 2 error mentality, and these are very intelligent people that write these books. These are mathematicians, PhDs. This is a book called Fooled by Randomness, and the whole book is about how everything's random, nothing matters in markets, nothing's real, right? That's the whole point of this, right? Well, let me show you something here, and I'll let you decide. Again, I'm neutral, and by the way, this is a good book. I mean, there's a lot of good information here. There are times when you are fooled by randomness. It's true, but not in the case of what we do here at Wolftrader. So here we go. So the random assumption is a problem because orderly systems can be modeled as random. So here's what I mean by this. You can have a system that is orderly, which I'm going to show you, but you can still model it as random. So what happens is somebody models this system as random on their simulator or on their whatever, their platform, and they're like, oh, it's random. Look right here. Look, the computer tells me. But it's orderly, and it's orderly because we can predict the direction. Okay? And this is the problem because you're making it's a type of an error. You're basically assuming because I can model it as random, it means that it's not orderly. That's not the case. There's limitations to model, especially with these models. It's very normal. A normal distribution is huge limitations. Huge. Okay? So let's talk about this. So you guys don't believe me? Let's look at recent Fed juice, dollar juice, and lunar cycle charts documented and time-stamped on Twitter. So there's no more Timers Digest, right? But there is Twitter. And so all of these charts are documented. So I just want to put that out there. It's at Wolftrader1 is where it's documented on. So let me just show you the, so at Wolftrader1. This is for the premium, the platinum subscribers, but this is the main handle where we post the live charts all day. This isn't the free one, but this is where all these charts are housed. And I love it because this is what happened. And there's documented proof of it. So it's not going to look real what I'm going to show you, but it's real. So first chart. Is this random? That's my question to you. Is this random? So this is the gold miners Fed juice. And I'm looking at this and you may think there's no way this happened. This is exactly what happened. This is exactly what happened. It's documented on Twitter, guys. So we'll come over here. And it goes all the way back to December. But we'll go over here to May. So April 27th, May 5th, May 6th here, June 7th, 21st, 23rd, 24th, 7-1, and then it catches this high here, down here, catches this low, catches this high here, and then it just goes into a buy Friday. Is that random? There's no way. There's no way that's random. You tell me the statistical odds that that's random. This is actually what we post to our subscribers. This is on the stock and ETF service. That's not random. So you can tell me all day that the system models it as random. It's not random. And there's tons of these charts, guys. We post this for the subscribers every single day without fail. Next one. You ready? Is this random? This is Tesla. This is the Fed juice here. Is this random? So you tell me, is this random? Look at these moves here. This is how it went down, guys. And then it's been in a sell since 8-4. You tell me, is that random? If you flip a coin a bunch of times, are you going to get that outcome? You're not going to get that outcome because it's not random. Especially with the Fed juice, we're modeling these markets beautifully. These are the ETFs. So this is, the first one was, like I said, was gold miners, and then this is Tesla. Okay, you ready for another one? And I'm just pulling charts up from what we post every day. And again, these are all timestamped. These are all documented. It's on Twitter. Next one. Is this random? This is a double lunar cycle. This is on natural gas. Take a look at this. 629, 7.8, 7.16, 7.21, 7.27, 8.3, 8.12, 8.17. Is that random? You tell me, is that random? That's not random. These turning signals were put at the beginning of the month. At the beginning of the month before so the lunar cycle comes, these are like preset signals. Is that random? That's not random. Next one, Fed juice. Take a look at this, 624, 629, 715, 731. Is that random? That's not random. You can't flip a coin a billion times and get these outcomes. Okay, so this is where I take issue with when people write books like that, because it's like, okay, you can model this system as random, but the reality is when we apply the Fed juice, when we apply the double lunar cycle, when we apply the dollar juice, when we apply the Fed juice internals, these are orderly systems, right? This is not random. And I'll keep going down the list here. I mean, it's endless. I mean, like I said, we post these every day. Next one. This is the dollar juice. Is this random? This is the S&P. You tell me. Is this a random market? Look at this. 2-2. I'll go down here. 2-2. February 2nd, February 23rd, March 1st, March 22nd, March 28th, 4-12, 5-5, 5-6, 5-21, 6-23, 6-29, 7-12. This one's down to here and then it goes up. 8-13, it catches the high here. Is that random? You tell me, is that random? Can you flip a coin over and over and over again and get that outcome? You're not going to get that outcome. It's not random. So again, but this is the thing about this. But you can still put that into your simulator and it tells you it's random. So you're like, oh, I believe the computer because the computer says it's random. No, it's not random. Look at that. We have multiple systems here that track the market. I've showed you now the Fed's use. I've showed you now the double lunar cycle. I'm showing you the dollar's use. What about the Fed internals? Let's look at that. Is this random? You tell me. Is this random? 9:15, 9:30, 10:15, 11:04, 11:11, 11:13, 1:15, 1:27, 2:08, 2:26, 3:25, 4:05, 4:15, 4:30, 5:11, 5:26, 6:07, 6:21, 7:06, and this one's still hanging out here. Is that random? You're going to tell me you're going to flip a coin and get that? It's not random. No way. So, you know, this is where these types of books and this type of thinking has limitations, because you get so indoctrinated to think it's random, it's random, it's random, it's random. There's no meaning, there's no meaning, there's no meaning. I rely on formulas. I rely on formulas. You know, that you miss the big picture, that things do come along. There is order into the systems, right? And so that's just, I just wanted to point that out to you. It's so obvious. So if you get too much into one way of thinking or too much into the other way of thinking, you're just in tribal thinking. Just like we see in politics, everything's tribal. That's all that you're doing. You're not trying to find the truth. You're not trying to understand the markets. And so this is where I'm going with this. All right. So I've just demonstrated to you that this is not random. And by the way, for those of you just joining us late, these are all documented and timestamped on Twitter. All of these documented and timestamped. So, you know, these aren't just charts that I pulled up and put arrows on. There's a history here. There's a timeline that is well established. Okay, so that's my basic contention with this. I am not against long options. I'm not against short options. But what I'm saying is the premise that it's random, I'm against that. And because we can have models that can help us understand, then we can apply that to options to get a way better perspective on things. If we have a stronger probability of a trend, then your options take on a different look in terms of, you know, how far you set your, you know, your strikes on your spread, and all these different things can be changed. You can risk less money. All of these things when you understand that there's an underlying trend there. All right, so we've gone through a lot here, and again, I'm trying to break this down into bite-sized thoughts to you, but I know it's a lot, but I want you to understand that you shouldn't fall into either of these types of errors, these types of thinking. There's a tribal thinking. Both of these are tribal thinking, and understand that they can both work. But I want to just show you more. I'm going to hammer on the type 2 people here again, the low volatility shark examples, okay? So there's multiple instances of funds who's tried a low volatility approach, okay? And it looked as if everything was going fine, and then it just blows up, okay? It's like out of the nowhere, it just blows up. Okay, so here's one here. So we're going to talk about this. This is long-term capital management fund. This is going back to the 90s, but let me just show you this. So this thing was from 94. It was doing great, okay? So here it is. This is the fund. And again, these are premium sellers. These are the people that think that there's no meaning to the market. There's no, you know, there's no direction. It's all random. It's all whatever. They're in the cult, right? The cult of there's no meaning to any of this. So, all right, so 94, we go back here to 94. And so this thing is just climbing and climbing, steadily climbing. So when you get these low volatility returns, again, this is what you expect to see. You expect to see a steady profit curve that rises and rises and rises across time, like this, rises and rises. Now, there is a point here in July of 1997, which is the Asian financial crisis. So this is the graph. I'm going to kind of slide this over so you can see it. So at first glance, it looks as if this has performed. Look, it pulls back a little bit here in the Asian financial crisis, but it looks pretty good, right? But then when this starts to see volatility coming in, increasing across multiple markets, you know, it looks like, hey, look, they're thinking, hey, we made it through the Asian financial crisis. We're doing pretty good, right? But then if you keep going here, what happens is it starts to hit a hiccup here. You see this? This is the first big pullback here. So you might say, well, you know, it's not a big deal. Look how well we've done since 94. You know, it'll be fine, right? Okay, well, we'll go forward another month. We'll go forward into June. Well, it's still falling, right? Well, okay, well, you know, look at this history. That's just a pullback. Look at this. This is, and again, this is dealing with low volatility. Get into July of 98. Oh, look, it's recovering. It's recovering. It's recovering. But let's get into August. Look what happens in August. Look what happens in September. Game over. Okay? So this is the danger of being short premium, thinking that you're doing fine and you're really not. So just understand it. Just understand it. You swim in the deep waters, there's sharks there. And that's what selling premium is. And we showed that example before, but that's what it is. You swim, you know, you think you're doing fine, you think you're doing fine, you think you're doing fine, and then bam, here comes the shark. So what I'm saying is, it's okay to be short premium, it's okay to be long premium, but just understand the risks that are involved with both of these. Okay? I don't like the fact that, you know, people think that this is some great thing that's better than long options. It's not. Okay, look at that. You want to see another one? LJ Max US equity, same concept, low volatility. They had some pullbacks though. You can see here there were some pullbacks. So, you know, they went through time and they were like, hey, this is for safe investors. This is for low volatility. We're trying to protect you. You notice it's just kind of steadily rising over time. Oh, there was a few hiccups here and there, but you know, we're playing the low volatility. Well, let's take a look at what happened here. First pullback here. This is a warning here, and this is related to the VIX volatility index, but they were relying on low volatility continuing, right? So let's see what happens here. Continue, continue, continue. Okay, it looks like it's recovering, and then volatility starts to really increase. Oh, here's another pullback here, and then what happens? Goodbye. Okay? That's the risk. That's the risk of doing these low vol. That's the risk of being an option seller, pretending like this is all random and all of that. Okay. Here's another one. You ready? Everest Capital. These guys were betting against the Swiss franc. It was a safe trade. They were just doing these small, steady trades, making money, selling premium. They managed over $3 billion. They had bets on the Swiss franc when the Swiss National Bank shocked markets in mid-January by removing a cap on the currency versus the euro. In other words, it wasn't pegged anymore. There was no cap. So the franc sourced 30% versus the euro, right? So it looked like a low-risk trade. It wasn't a low-risk trade. There's no such thing as a low-risk trade, right? And so because it looked so low, they weren't really concerned about capping it, right? Why would we make it into a credit spread or a debit spread when it's just always making money, right? And because that happened, there was no, you know, I don't know the exact mechanics of this, but I know they were just short all the time on this franc, this low volatility play, short premium, all this stuff. It can and it will happen. Okay, it's just a matter of time. It will happen. And for those of you who are subscribers, I have a personal story about this. I will tell you about this on the weekend update on Sunday. I'll tell you a story about this. I have a personal story about this of people that I know involved in this. But it's not that, it's just the point is everybody can be vulnerable to this type of thinking. And I'm just trying to make you aware of it, that you can think everything's fine and it's not, the type 2 error. All right, we're coming. I know this is getting long, guys. Sorry, this is like over an hour now, but let me get into short-term volatility considerations. So there's another issue here with the volatility. Volatility is a big deal with options. It's a huge deal. And it's not just implied volatility. It's also Bollinger Bandwidth. There's different ways to look at this. All right, so volatility is a major issue for option traders, okay? Because depending on where the volatility is, it affects your, you may want to be long options or short options, depending on what's going on. So there's many things that affect volatility. So, you know, one of them is earnings. So when earnings come out, the implied volatility can be really high before earnings and they can collapse. They could be news events, like we saw with Afghanistan over the weekend, COVID, right? We saw that, and I'll show you a chart of that in a minute. The Fed juice, Fed meetings, Fed everything, right? On the opening market, the volatility is usually higher. There's all types of things happening here that affect it. And that affects you. Like when you want to put on a position, depending on if you're long or short, this stuff matters. It matters big time. So all of this stuff comes into play. And I just got a few more slides here on this, guys. I know this is getting long, but I assume if you're here, you're interested. So I'm just trying to distill this information down to you to let you know what's involved with this. So there's different ways to measure volatility. The most popular way is implied volatility, and some people believe it's above 50, you're into debits. If it's below 50, you're doing credits. It depends. It's not that clear cut, but that's just one way to look at it. But the implied volatility, and another way that I really like is the Bollinger Bandwidth. I really like this. When it gets low, it's almost always an increase in volatility, and I'm going to show you some charts in a minute. So long premium volatility collapse can cause a move in the correct direction to lose money. So let me say that again. You can be long a call and it goes up, but the volatility goes down and you lose money. Or before earnings, you could be long a put and the volatility is high, and then after earnings, the price drops and you lose money because you didn't time the volatility right. For short premium, volatility collapse can cause a move in the wrong direction to gain money. So if you're short, right, and so this is why everyone's looking for volatility. They're like scavengers. They're like hunting and hunting and hunting for implied volatility. I want an arbitrage. I want a volatility that's mismatched. I want all this stuff. Well, sometimes they get it and they get a high implied volatility and the volatility collapses, and even if they're wrong, they can make money. That's crazy. That's the craziness of options. But the contrary is true too. If you're long premium, volatility spike can cause a move in the correct direction to amplify gains. So if you're long on a position like this and it expands very quickly, then there's a region in there where the volatility increase can really amplify your gains. And if you're running out of time before the option expiration, that's probably in that case, it's probably the good time to bail if you don't have a lot of time left. For short premium, volatility spike can amplify losses. This is huge. This is what happened in COVID. So people thought that the volatility was high, it can't get any higher, and they kept selling premium and they got smacked. Right? So volatility spiked and they could be right. They could be betting it's going down, but they're still losing money because the volatility increased. So the point of this is that it's important to time unreasonable volatility extremes and be aware that there are events that are out of your control, like COVID. All right, so let me show you a chart here. This is Bollinger Bandwidth. I really like this, guys, in terms of identifying low volatility. I don't like it so much for high volatility because we'll see with COVID that high volatility can go really, really high. But typically low volatility, pick a line here. I have a line here, and the S&P tends to expand its volatility when it hits this low line. So in February here, you can see it comes down to this low here in February. You see this? And the volatility was low, and then the volatility starts to increase here. You see this? So Bollinger Bandwidth is really important for finding low volatility entries. Here's another one here on B. It comes back down to this line. Now this line, this is the same line I'm going to show you for COVID. In other words, this is a pretty consistent line here. And the letter B here, you can see when that Bollinger Band gets low down there, low volatility, you can see the volatility increasing here. And the letter C here. In this case, the volatility was low, 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 and then it just hooks and goes higher. And then in the case of D, this is what I was warning people about recently. We had that Fed use internals dropping, but the Bollinger Bandwidth comes down to this low level down here, and that was the end of the low volatility. You can see the volatility is now starting to increase again. It doesn't always tell you the direction of the move, but it tells you the volatility is going to increase. So if you're trying to be long options, it's probably a good idea on some time frame to try to find a low volatility point, because you don't want to get caught up in the high volatility if you're trying to be long, and then all of a sudden the volatility ends, and you bought at the wrong time. All right, so one more example here, and we will be done with our type 1 and type 2 lecture today. COVID, guys, this is a perfect example. In a crisis, volatility can keep expanding and expanding and absolutely destroy option sellers of premium. So you can be selling calls and thinking, hey, this thing's going to collapse, and then you still lose money because the volatility is expanding. So even in low volatility, safe stocks exploded. So we saw this in COVID, even the safe stocks. So if you're in low volatility environments, even those exploded. So here's the chart with COVID. Now, this is the same line. I'm going to move out here so you can see this. This is the same line here that right here. This is the 94.8. You can see this. This is the same line that I used in the other chart. But look, it comes back to this line over and over again. You see this? This was the low during COVID. It didn't quite get there during COVID. It was very close. But on the letter E here, notice there was just ultra low volatility. And then all of a sudden, right? All of a sudden, it all breaks loose here. You see this? Just wildness happens. So I think this is a useful tool for determining low volatility, but for high volatility, it's a lot trickier because look, in the past, this was a high volatility here. You see this here? This was high volatility, right? And then all of a sudden now look at these new peaks and you thought maybe it was over here. No, it kept going, right? And so this is the problem with trying to time the high volatility, because when you have a crisis, because it can keep going and going and going against you. And that's what happened in COVID. So it's a lot harder to time these peaks than it is to time the lows. I think it's a lot easier to time the lows, but that's just my 2 cents on that. So I think the Bollinger Band is a very useful tool for finding the low volatility right before it explodes. And like we said, a lot of times it's better to be long on the premium. So getting long in the tooth here, guys. Just to show you, so let's go down to the market update here. And we will close this out for questions. If you guys have any questions, go ahead and type it in the stream here. I know this was more of an academic lecture today, but it's important information that you understand this, that you understand the risks involved with this stuff. Market update. So very briefly, we'll talk about the S&P here. All right, S&P. Well, the Fed use internals are still in a sell, and we've been talking about since July the 6th. I showed you on that other chart that the Fed internals are still pressing down. I don't see them pressing up. The Fed doesn't seem to be in any type of a hurry right now to push this market back up. The S&P finally showed some selling on the market, which was interesting because we had been hanging out there for so long, but finally on the Afghanistan news, it started to sell off. The fear and greed has been very strange, peaking with price. And then again, August is a negative month, and also into the beginning of September is still negative. So I think there's still a lot of danger here. And I've talked about this Fed juice here. Every time the Fed has pulled back, this is going back to 2011, the markets have followed. Another example here in 2012, the Fed pulls back and the market follows lower. These are just some examples. This is where we are now. This was the 2018. This was the taper tantrum here, just to give you a perspective. This is a weekly time frame too. So this is weekly. And you can see when this Fed pulls back, the market drops. The Fed pulls back here. And right before the election, May to November, the market has issues. So the Fed has been really pulling back right now. And I've been talking about this, that this is not a little pullback. This is on a weekly time frame. And this stuff tends to show up for weeks. It could show up for 2 months at a time. We saw here it showed up for 2 months. This was at least, let's see, you had this one showed up for a good 3 to 4 months here. So what's happening now is not a little pullback. This could be showing up for months here on the S&P, and I don't think we're out of danger in any sense of the word right now. The Fed internals are still weak. They had a little bit of a hookup here. You can see it hooked up a little bit, but it's not enough to put this back into a buy. And I don't feel that the S&P is out of danger by any sense of the word, guys. This is still a high, in terms of what I've seen with the Fed, in terms of this model, this is a highly dangerous situation right now still, especially with all the Afghanistan news coming out and everything that we're seeing. This is dangerous, guys, and I've been talking about this. Now, remember, this has been since 7.6. Notice that the trajectory of the rally was about to go parabolic here. You see this, how it was getting steeper, and the minute they cut it off, at first it falls, and then the trend line was much weaker here. You see this, how this deflects down like this, and then finally it just broke the other day. Friday it did hook up. I did talk about Thursday there was going to be a short-term low coming in, or the possibility of it, and it looked like it wasn't going to happen, and then it happened. But there's still plenty of danger out here, guys. So I would just caution everybody on this S&P to be careful, because if this thing wants to dislocate, it can move down in a hurry without the Fed. If the Fed is going to continue to be weak like this market can move fast to the downside, guys. And we know that when the moves come, you get in 2 days, you wiped out 9 days. So you can have all these little tiny up moves come, and then when the down move comes, it wipes it out. So be careful on this. This is not in the clear by any method. And again, I will tell you, I will be the first one to tell you guys, if this goes into a buy, I will tell you it's not. It's not. So even though we have this volatility like this hooking up, this is still in the danger zone. I do have this Astro inversion model that we've been working on, which is it's a model that measures when cycles invert. And so we've been looking at this on the S&P. This has been in a sell since July that's 26. So it's still in the sell. So it didn't take the bait on any of this. When it tried to go up, it still said it's in a sell there. It's still in a sell here. It's not taking the bait on this. And none of those other charts did either. When I talked about that dollar juice, the dollar juice didn't take the bait on this. The Fed juice didn't take the bait on this. Nothing is buying this, okay? That this is going to continue up. Until the Fed turns this situation back up, the S&P is vulnerable, okay? It's very vulnerable right now. Now, we do have fiscal stimulus out there. We do have checks coming in. We do have, Congress did act. Maybe that's why it's floating around a little bit longer out there, because there's all of these variables coming in now to the market that we've never seen before. But in terms of what I'm looking at, in terms of the Fed, this is the big show, guys. This is the big deal. What's going on with the Fed? That's what runs the show in terms of the S&P, and that is still negative. So I would be worried. Even if this hooks back up and makes a new high, I'd still be worried. As long as this is falling, the market's going to have problems. There's not one time since 2009 that this has happened that the market hasn't come back. It already came back to the starting point here. Even though it rallied back up, it already came back and touched this, but you can see that it's having issues here. Okay, so we'll see what happens early on Monday and Tuesday, if this can hook back down, and I'll talk about that in the market update video. But shorting the S&P is difficult, but when you see a situation like this, I would say, look, this still has potential. So just be careful out there with the S&P, because if the Fed's not there, it's not going to do it. All right, so just summarizing, guys. I know that was a long session. Just real quick, so if you want to try this out, we got different newsletters. We got S&P, we got metals, we got energy, we got currencies, we got cryptocurrencies, we got Uranian astrology if you want to talk about that. It's not dealing with the markets, but it's just very interesting topics on people and events. This is stock market, ETF, and Fed use service. You saw those charts earlier that I showed you. And then the gold membership here, it includes all of these. This is a bundled package if you want to get those. And then if you want to get the platinum, you get all of that. Plus you get live Twitter, trading services, fast Fed, easy timer, ETFs, pairs trades, K2, and then all future services are grandfathered. These rates will go up in October. So if you are interested in any of these, this is a good time to get on. And the reason the rates go up is because we do add more services, and these forecasts are getting more accurate. And the stocks and ETFs have been incredible. You saw those charts with the GDX, and I anticipate them to continue to get better. But it's a process. It takes time, and that's why we start this out you can head over to Wolftrader Futures here. If you want to sign up, you go over to where it says pricing plans up here, and it will take you there. You can get a 7-day free trial on any of these. And so check it out. I think it'll be worth your time. And if not, no hard feelings. Go along your way after a week. That's fine too. But we are here, and each day I think we're getting better, and we're consistently here every day with you to post information each day. Like I showed you on those charts, I'll go back really quickly to those charts. But just going back here, these are real charts that have been posted, guys. This is the gold miners here. This is, it's just been incredible. These are the actual buy and sell signals that have happened on the gold miners here. This is one of our best ETFs. We also have other ETFs. Actually, I didn't cover these real quick. I'll go through these. This is Apple. Apple caught that first big run up here. Apple's in a sell. Tesla has been incredible. I mean, just phenomenal. I didn't envision it being this good even when I started the service. These are incredible moves that are happening, and they're being tracked daily with the Fed juice. And this is Broadcom. Broadcom finally started. It was going sideways for a long time. It finally started modeling the market a little better. Caterpillar is modeling the market well too. Bank of America is also modeling the market well too. So this is in the stock and ETF service. And if you want to sign up now, if you're a non-member, it's $59 a month. If you sign up and you like the service, this is a good time to sign up because the prices will be going up. It will not be $59 in October. I promise you that, because we have a track record now. It's established. It's going forward, and we will be adding more symbols. And anything that's added to that, you keep that rate for life. It's locked for life. So you're going to look back on that and say, wow, that was cheap. 59 was cheap. Because it will be going up. And then existing members, if you're an existing member and you want to try the ETF stocks, you can try it for $49 a month. And I think it's a good deal. I really do. And when we're there every day, I mean, I'm there to answer questions if you have questions. And, like I said, we are constantly working to update and monitor. And each week there's stuff going on, constant upgrades going on behind the scenes to make this better. If you want to reach me, you can reach me at shane@wolftraderfutures.com. Just going to start this here, or www.wolftraderfutures.com, or fedjuice.net or fedjuice.com. We have both domains. YouTube is Wolftrader Futures. Twitter, Wolftrader FUTU1. That's the free one. You can sign up for that. At Wolftrader1, this is where all of those charts are documented that I talked about. And then, of course, we're on StockTwits and Facebook. So we're in a lot of places. It's very easy to reach me if you have any questions. So if you guys have any questions now, go ahead and type it in the chat. And I know this one got really long today, guys. It's an hour and 23, but that's what it is. So any last minute questions? I guess not. I guess we are good today. Everybody took out their pen and pad and took notes today, right? Like I said, each week we're going to be talking about something a little bit different. Last week we talked about nutrition and how you should be eating to keep your brain going and to keep the high energy level going. Today we're talking about options. I know this is heavy stuff. You might want to go back and rewatch the video, but I'm just trying to distill this information for you guys and let you know the important things about what to look for when you're doing different strategies. So, maybe in another week we will talk about how to set up those strategies, how to construct spreads, and different ways to look at the options. But this was really a high level view today. So thank you so much for everybody for coming. I really appreciate you spending your Saturday afternoon with us. And if there's no more questions, I will be signing out pretty soon here. And that's basically it. So